Andy Burnham's leaked property tax plans are rattling landlords across the country, and early reports suggest this could hit some property owners far harder than others. Leaked documents are not the same as confirmed government policy, so before diving in, it's worth separating what's actually been proposed from what's simply rumor. Government records confirm one thing for certain. The high-value council tax surcharge is scheduled to launch in April 2028, targeting residential properties worth £2 million or more. Officially, owners in that top bracket would pay an extra annual charge starting around £2,500, rising to £7,500 for the priciest homes. Under the leaked proposals now circulating, that $2 million threshold could be slashed down to $1.5 million, dragging thousands more properties into the tax net. Property values in London and the southeast sit close to that line already, which means a small policy tweak on paper translates into a massive real-world shift. That £500,000 drop might sound minor next to seven-figure house prices, but analysts estimate it could pull an extra 150,000 homes into scope. Homeowners in expensive postcodes are the obvious target, but landlords need to pay even closer attention, because this tax isn't reserved for mansions with marble floors. Landlords who bought an ordinary family home decades ago may now own a property worth well over $1.5 million purely because prices climbed around them. Picture a landlord who never renovated, never upgraded, and never chased profit, yet finds their modest rental suddenly classified as high value simply through market drift. Unlike income tax, which rises because you're earning more, this surcharge can hit you purely because an asset you already own has grown in paper value. Tenants might assume this bill lands on them, but based on current proposals, it's the landlord who receives the charge directly from HMRC. Add mortgage interest restrictions, rising insurance, growing compliance costs, and licensing fees, and a new annual surcharge could tip a thin-margin property into the red. Government estimates suggest the current $2 million threshold alone could raise hundreds of millions of pounds, and lowering it further would push that figure significantly higher. Direction matters more than the exact number here, because once a policy like this becomes law, landlords have very little room left to plan around it. Higher value property is quickly becoming one of the easiest places for cash-strapped governments to look when the books need balancing. Compare that to the wealth people assume comes with owning a valuable property, and you start to see why so many owners feel blindsided by paper gains. Section 21, no-fault evictions were, for decades, one of the most powerful tools landlords had, letting them regain possession without proving the tenant did anything wrong. For years, a landlord could simply serve notice, follow the correct process, and ask a tenant to leave once the notice period ended, no explanation required. It changed for good under the Renters' Rights Act 2025, which abolished Section 21 entirely from the 1st of May 2026. Instead of fixed-term tenancies landlords could end at will, every new tenancy is now periodic, with no built-in end date whatsoever. Landlords can no longer simply decide they want to sell, move back in, or swap tenants and lean on Section 21 to make it happen. Proving a legal ground under Section 8 is now mandatory, covering situations like selling the property, moving in family, rent arrears, or serious antisocial behavior. One letting agent recently described a troubling side effect. More prospective tenants are showing up with county court judgments tied to previous tenancies. CCJs don't just affect the tenancy where they originated, they follow a tenant into every future credit check, often making it harder to secure the next home. Fewer eligible applicants means longer void periods for landlords, and some are already being forced to relax reference criteria they'd normally never compromise on. Miss the deadline, and any Section 21 notice served before the 1st of May 2026 becomes worthless if a possession claim isn't filed by the 31st of July. Regulation has piled up steadily for landlords in recent years, from tighter energy efficiency rules to stronger tenant protections and expanding enforcement powers. Every time landlords adjust to one new requirement, another seems to land almost immediately, and that frustration comes up constantly in client conversations. Turning to Burnham's own record helps here, because the clearest signal of future national policy is often what someone's already done with the power they had. Greater Manchester isn't the same as Westminster, and a mayor's powers are nowhere near a prime minister's, but the direction of Burnham's approach still offers real clues. Roughly half of all rented homes in Greater Manchester now sit under his Good Landlord Charter, a voluntary scheme built to reward high standards and flag repeat offenders. Enforcement is the other half of that picture, and Greater Manchester has taken an increasingly tough stance against landlords it considers to be failing tenants. Numbers published by the combined authorities show enforcement action generating £1.47 million in civil penalties over 2 years, with fines up 43%. Burnham has consistently drawn a line between good landlords and rogue landlords, insisting the former deserve support while the latter should face real consequences. Repeated failures to fix serious property issues have drawn talk of tougher intervention, including a three-strikes model that could, in extreme cases, lead to compulsory purchase. Compulsory purchase powers wouldn't apply to every landlord who slips up once. This is squarely aimed at repeat offenders who ignore enforcement action entirely. None of this confirms exactly what national policy would look like, but it does show that stronger accountability isn't a new idea for Burnham. Step 1 for any landlord right now is figuring out whether the property is genuinely still working, not just looking good on a valuation certificate. Ask yourself honestly, if you were starting from scratch today, knowing everything you know now, would you still buy this exact property? Mortgage rates locked in years ago at 2% look completely different once refinanced at today's rates, and that alone can flip the numbers. Rates, insurance, maintenance, letting agent fees, and compliance costs all deserve a fresh look, because a property that worked a decade ago might not work now. Question 2 is structural. Should properties sit in your own name or inside a limited company, and there's genuinely no single right answer? Section 24 still restricts individual landlords from deducting full mortgage interest, replacing it with a tax credit that's pushed bills up sharply for higher-rate taxpayers. Move that same property into a limited company, and mortgage interest typically becomes a deductible business expense against corporation tax instead. Transferring existing properties, though, can trigger capital gains tax, stamp duty, additional surcharges, and legal costs that often outweigh the benefit entirely. Get proper advice before assuming this is obvious, because the right structure depends on portfolio size, income, long-term plans, and whether profits get reinvested or drawn out. Third on the list is compliance, and the landlord's enforcement tends to catch aren't usually the deliberately bad ones. They're the ones who let paperwork drift. Missing a renewed certificate or a lapsed license rarely happens on purpose. It's almost always a symptom of weak systems rather than bad intent. Most disputes come down to documentation: a compliant tenancy agreement, valid gas safety certificates, correctly protected deposits, and any licenses your local authority requires. Certificates, inspection records, repair logs, and tenant communications all matter, because organized paperwork puts a landlord in a far stronger position during any investigation. Records built after the council or HMRC gets involved are far less useful than records kept from day one, long before anyone comes asking. Best practice is treating compliance the same way you'd treat rent collection, something reviewed regularly rather than remembered only when it becomes urgent. Nobody can say with certainty what Andy Burnham's national property policy will eventually look like, since much of what's circulating remains unconfirmed leak rather than law. Leaked plans around the mansion tax threshold, in particular, have not been officially verified by Number 10, and that distinction genuinely matters. Focus less on any single headline and more on the direction of travel, because that pattern is where the real risk to landlords is building. Landlords who cope best with regulatory change tend to be the ones running their portfolio like an actual business, reviewing numbers before problems force their hand. Share this with another landlord, property investor, or business owner who genuinely benefit from understanding where these changes might be heading. Subscribing helps more than people realize, since roughly 3/4 of everyone watching this channel still hasn't hit that button. Thanks for watching, and if this was useful, there are more videos linked here breaking down exactly what's coming next for landlords.